Welcome back to Mindful Restarts. Let's dive into the recent mass resignation of U.S. federal employees, starting with government operations. Federal employees handle a lot of essential services, like processing Social Security, IRS tax returns, national parks, and public safety. If many quit, these services might slow down or stop. That could mean delays in benefits, which would directly affect people who rely on them, possibly reducing their spending power. Then there's regulatory oversight. Agencies like the FDA or EPA might not be able to monitor industries effectively, leading to potential safety issues or environmental problems. That could harm public trust and maybe even lead to health crises, which would have economic costs. Next, the labor market. If a lot of people leave federal jobs, they might move to the private sector. That could increase competition for jobs there, maybe driving wages up, but also filling vacancies that companies have. However, the sudden influx might create a mismatch in skills. Federal jobs often require specific expertise, so if those workers aren't a good fit for private roles, it might not help much. Unemployment could rise temporarily if they can't find new jobs quickly. Consumer spending and confidence. Federal employees are a significant part of the workforce. If they resign en masse, their spending power might drop, especially if they don't have new jobs lined up. That could reduce consumer spending, which is a big part of the economy. Plus, if people see the government struggling, they might lose confidence, leading to less investment and spending, which can slow economic growth. Contractors and private sector reliance. The government often hires contractors. If federal employees leave, they might rely more on contractors, which could be more expensive and less efficient. On the flip side, private companies that provide these services might see a boom, which could be good for their sectors. But there's a risk of increased costs and potential for corruption if oversight is lax. Long-term economic impacts. The federal government funds a lot of infrastructure projects, research and development. If there's a brain drain, those projects could stall, affecting long-term productivity and innovation. Also, the government's ability to respond to crises, like economic downturns or natural disasters, would be weakened, leading to slower recoveries and more severe impacts. Fiscal implications. Federal employees pay taxes, so mass resignations could reduce tax revenue. At the same time, if unemployment benefits kick in for those who can't find jobs, government spending might increase, worsening the deficit. This could lead to higher borrowing costs and affect the government's credit rating. Public and investor confidence. Uncertainty about government stability can spook investors. Stock markets might react negatively, and foreign investment could decrease if the U.S. seems unstable. The dollar might weaken, affecting international trade. Comparisons to historical events. The 2013 government shutdown showed that even temporary disruptions can cost billions. A mass resignation would be more prolonged, so the effects would be more severe. However, the economy is resilient, and some sectors might adapt, like private companies stepping in or automation filling gaps. Possible mitigations. The government might offer retention bonuses, faster hiring processes, or temporary workers. The private sector could absorb some workers, especially in areas like IT or healthcare. Automation could help maintain services with fewer people. In conclusion, the economy would face immediate disruptions in services, labor market shifts, reduced consumer spending, and possible inflation from higher wages. Long-term issues include stalled projects and weaker crisis response. The severity would depend on how quickly the government can adapt and how other sectors respond. Historical examples suggest significant but manageable impacts with proactive measures. The mass resignation of federal employees in the U.S. would have multifaceted economic impacts, ranging from immediate disruptions to long-term structural challenges. Here's a structured analysis. 1. Government operations disruption service delays. Critical services, e.g. Social Security, IRS, passport processing, would slow, reducing public trust and potentially harming vulnerable populations reliant on benefits. Regulatory gaps. Weakened oversight of industries, e.g. a FDA, EPA, could lead to safety risks, environmental harm, or financial instability, increasing long-term costs. Contractor reliance. Increased dependence on private contractors might raise costs and reduce accountability, though some sectors, e.g. defense, IT, could benefit from expanded contracts. 2. Labor market effects. Private sector shifts. A surge of skilled workers entering the private sector might alleviate labor shortages in tech, healthcare, or engineering, boosting productivity. However, wage inflation could occur in competitive fields. Skill mismatches. Federal roles, e.g. regulatory specialists, may not align with private sector needs, leading to temporary unemployment or underemployment. Unemployment costs. If resignations outpace private sector absorption, short-term unemployment claims could strain state budgets. 3. Consumer spending and confidence. Reduce spending. Unemployed or transitioning workers might cut discretionary spending, dampening demand in sectors like retail and hospitality. Confidence erosion. Public and investor anxiety over government instability could reduce consumer spending and business investment, slowing GDP growth. 4. Fiscal impacts. Tax revenue loss. Reduced federal payrolls would lower income tax receipts, potentially widening the deficit. Increased spending. Unemployment benefits and contractor costs might offset savings from reduced federal salaries, straining fiscal budgets. 5. Long-term risks. Infrastructure and innovation stalls. Delays in federally funded projects, e.g. transportation R&D, could hinder productivity and competitiveness. Crisis response weakness. A depleted workforce would impair responses to recessions, pandemics, or disasters, exacerbating economic damage. 6. Market reactions. Investor uncertainty. Stock volatility and capital flight might occur if governance instability persists, weakening the dollar and raising borrowing costs. Sectoral shifts. Defense, healthcare, and tech sectors could see growth from increased contracting, while others, e.g. tourism, suffer from regulatory delays. Historical context and mitigation precedent. The 2013 shutdown cost $24 billion, suggesting prolonged disruption from resignations would be far costlier. However, economic resilience and private sector adaptability could soften the blow. Solutions. Retention incentives, accelerated hiring, automation, and public-private partnerships might mitigate impacts. Conclusion. The economy would face immediate shocks, service delays, labor market churn, and long-term risks, reduced innovation, fiscal strain. The severity would depend on the scale of resignations, speed of government adaptation, and private sector capacity to absorb workers. Proactive policy measures and leveraging technology would be critical to minimizing damage.